Hi there, welcome to Kneppy Invest. I haven't done a standalone video on Bravura solutions before, even though this was a market darling back in 2017-18. In fact, I will have a look at the chart during those years, and this was almost a six-bagger for those who held during that period. And in fact, the market cap of this company was above $1 billion for a period of time back there. And I was back then thinking I should have taken a position in this company simply because of the stellar share price performance of the company. For those who don't know, Bravura Solutions is a provider, a software solution provider for the wealth management, life insurance, and funds administration industries, and they have been facing significant headwinds over the past few years, which has seen the share price collapse and severely collapse on 2 days in the past 4 months. Back in November, the share price of Bravura Solutions fell 50% in 1 day. And there would have been some investors who thought, well, the share price has collapsed 50%. That's the end of bad times for this company. I'm going to buy in, waiting for the bounce. The bounce sort of came. Share price did improve a little bit. But on the 7th of March 2023, the company came out of a trading halt. They released the half-year results, and they also gave a trading update. They also had a capital, or announced a capital raising, a highly dilutive capital raising for investors. I think 80%. They're going to raise 80% of the current shares, and the share price fell another 50%. So twice in 4 months, the share price of this company has fallen by 50% in 1 day. So let's get back in time to when this company was a market darling. So even though at times companies can be favored by the market, doesn't mean those good times will always last. This is definitely true for Bravura Solutions. And this is their daily chart from when they listed in late 2016 all the way through to the middle of 2019. Share price went from $1.25 all the way up to a high of $6.25. So in 2019, the market cap of this company was around about $1.1 billion. They had $256 million of revenue, $33 million of profit. Their return on equity and return on invested capital were quite good at around about 15 or 16, depending which metric you look at. P ratio 33. So the market was expecting continual good growth for this company, and the EV to EBIT a little bit lower at 24. But again, that valuation metric was on a little bit of a high side, probably indicating the market was expecting some further good growth for this company. And this was an absolutely beautiful chart, the sort of chart you want to be a shareholder of. But sometimes the good times come to an end, and those good times came to an end in 2019. And that share price high in 2019 at $6.25, whatever it was the all-time high for this company. And after the high, the share price really struggled to move further up. During the COVID-19 financial panic, the share price of Bravura fell to just below $3. There was a nice little bounce, but the share price started to move down again, moved into a nice little downtrend. In fact, the share price then moved below the COVID-19 lows, which was actually probably a warning sign, because the share price actually fell down to about $2.50 in March of 2021. And then in August 2021, the company released their full-year results, and the share price was down 16% on that day. And even though the management were quite optimistic about the future of the company, the market wasn't believing it at all. And that was a catalyst for a shift in sentiment and the move of the share price into a well-defined downtrend. So let's have a look at the reason why the share price collapsed 16% on this particular day. Nothing like 50% we have seen twice in the past 4 months. So in financial 21, even though the market was expecting good times ahead for the company back in 2019, those good times possibly affected by COVID-19 and the management of Bravura Solutions, and the management has been cleansed out. A new CEO, a new CFO, but the management back here were blaming COVID-19, and maybe that was justifiable. So revenue down 11%, EBITDA down 15%, profit down 14%, to 34.6 million, adjusted profit down to 32.3 million, EBITDA margin down to 20%, earnings per share down 15% to 14 cents. They're still issuing dividends. So even though everything was down here, the management was still optimistic. So I do not advise, but I do recommend going back, having a look at this particular report, having a look at the optimism in management, thinking they could turn things around. I think their guidance for financial year 22 was an improvement on EBITDA or revenue in the double digits, and they didn't actually achieve that. Things continued to move downwards. So the market actually didn't believe management at all, and you'll be able to see that when we look at the chart. But we won't look at the chart just yet. I just want to compare the 2019 numbers results to 2021. Now, 2021, according to management of the company, was highly affected by COVID-19. They're still sort of blaming COVID-19, but at some point in time, they have to stop blaming COVID-19. Anyway, market cap back in 2021 had decreased to 868 million, revenue down a little bit to 241 million, profit up a touch to 35 million, but not really the growth the market was expecting. On the concerning side, return on equity and return on invested capital was falling. And in fact, return on invested capital fell below double digits. And that is a bit of a warning sign, red flag right there. P ratio had dropped to 25 and the EV to EBIT dropped to 20. So you probably could argue, well, the company is cheaper now, but that is the market saying we don't expect the growth. But even at a P ratio of 25 and EV to EBIT at 20, I think at that point in time, when the company did release their financial results in August 2021, I still think at that point in time, the company was slightly overvalued. And of course, that's in hindsight, because I know what happened after that. So not slightly overvalued, they were completely overvalued. Anyway, so back on 25th of August 2021, when the company did release their results, the company was still, the management of the company was still a little bit positive. So this is their financial year 22 guidance. So the COVID-19 pandemic continues to impact Bravura's key markets. The near-term outlook remains uncertain. However, this is them being a little bit more positive. The sales pipeline remains strong, and the company expects financial year 22 NPAT growth. So I thought it might have been revenue, but it's profit growth in the mid-teens relative to financial year 21 adjusted NPAT of 32.3 million. So they probably expected, if you're going to get 15%, say, a growth in NPAT, that means profit should be approaching $40 million. And they got nowhere near $40 million when they did eventually release their financial year 22 numbers 1 year after this particular date. And the market did not believe Bravura Solutions. If the market believed Bravura, after that 15% or 16% drop in share price, when they did release their financial results in August 2021, the share price wouldn't have moved into a well-defined downtrend, and it absolutely did. This is an absolutely beautiful downtrend in the share price of a company, just like it was a beautiful uptrend in the share price of this company back in 2017 and 18. This is the sort of chart you don't want to see if you are a shareholder of the company. And the share price just kept on falling gradually. No massive decreases in share price from August 21 all the way through to November 22. And then the share price fell 50% in early November. Massive volume came through that day. Share price actually did drift higher from that date all the way through to 7th of March. And then the share price dropped another 50% on further bad news from the company. So let's have a look at the bad news, the reasons why the share price dropped 50% in these 2 trading days. The first time the share price of Bravura dropped 50% was on the 2nd of November 2022, when the company released an announcement, strategic review progress, business update, and financial 23 guidance. And whenever you see a share price drop like 50%, more than likely the guidance the company has issued was not liked by the market, and the market absolutely hated this company's business update and financial year 23 guidance. We'll have a look at that guidance in either the next slide or the slide after. And then on March the 7th, the company share price fell another 50%, and they did release a lot of announcements on this day. Now, the company was in a trading halt because they were supposed to release the half-year results before the end of February. They could not. They finally released the half-year results. The half-year results were quite bad. Not only did they release bad half-year results, they also announced a capital raising, a highly dilutive capital raising for shareholders at a massive discount to the current share price. That's another reason why the share price fell 50%. They also issued a trading update, and it was a profit downgrade, and the market absolutely hates profit downgrade. So you had three really bad things happening to Bravura on the same day. Bad results, highly dilutive, highly discounted capital raising, and a profit downgrade. And that's why the share price fell 50% in one day. So before we have a look at the guidance the company did issue back in November, because it's very important to know the change in guidance, because when a company does issue a profit downgrade, you need to know what that downgrade is. Thankfully, when they did issue the downgrade in the 7th of March announcement, they did compare what the previous guidance was. But we have a look at the first guidance, and even with that first guidance back in November, the share price dropped 50%. So this is their first half financial year 23 results, and these were pretty ugly reading. Revenue down 11% to $118 million. Expenses up 17%. So even though revenue is down, expenses rose 17%. So back in the first half of 2022, revenue was $132 million, expenses $107 million. So with revenue down, expenses up, expenses were more than revenue by $7 million in this first half. EBITDA loss of $7 million, down $32.3 million from a profit of $25.3 million. Adjusted NPAT loss of $14.2 million, down $30.3 million from positive $16.1 million in the first half of financial year 22, and no dividend declared to provide cash flow support. So not only were these ugly results, the company is no longer issuing dividends or paying dividends to their shareholders. On the 2nd of November, the company did release some guidance for financial year 23, and they updated that guidance on the 2nd or the 6th of March. Now, they released some of these announcements on the 6th of March. So that's why I got the 6th of March here. And because they released the announcements after trading had finished, they started trading back on the 7th of March. And thankfully, when they did issue that profit downgrade, they did compare the previous guidance to the current guidance. So we'll just look at the table on the bottom here. So in their previous guidance, they did expect revenue to be between 270 and 275 million. Now they expect revenue to be between 240 and 245 million, which is actually lower than the revenue they achieved back in 2019. So if you remember back in 2019, they had revenue of 256 million. So the first thing I look for with companies is whether there is any growth in revenue. And right now, we can't say that with Bravura because revenue has decreased over the past 4 years. Not only that, EBITDA, they were expecting it to be positive between 10 and 15 million in the previous update on the 2nd of November. Now they expect it to be negative between 10 million and 5 million negative EBITDA, and adjusted NPAT profit, they'll expect to be almost profitable in their previous guidance. Now they expect to be highly loss-making between 24 and 19 million dollars loss-making. And with cash flow, they said likely negative in the previous announcement. Now they're saying it's going to be negative. No doubts about it. This company will have negative cash flow in financial year 23. So this is another reason why there was a massive sell-off in Bravura shares, because this was a classic profit downgrade. Now, one thing I have not mentioned in this particular video is the capital raising. It's a highly dilutive capital raising. They're raising about 80% of current shares. So the shares on count will almost double. And if you do look at the current market cap through any platform, probably say the market cap of Bravura is around about $100 million, maybe just less than $100 million, because last time I looked, the share price was down 6%. I am recording this video at about 2 p.m. Eastern Daylight Savings Time, so 1 p.m. local time, so about 1 hour of trading left or something like that. And with the share price down about 6%, the market cap of this company, current market cap, should be less than $100 million. But once they do this capital raising with almost a doubling of shares, that means the market cap with the extra shares on issue will be closer to $200 million. So you do have to take that into account. They will have extra cash, so the enterprise value won't rise as quite as much. But this highly dilutive capital raising is probably another reason why the market has sold off on Bravura Solutions on the 7th and now the 8th of March. If you have any questions in regards to Bravura Solutions, if you're a long-suffering shareholder of this company, I'd love to hear your thoughts. Are you adding to your position at these lower share prices? Are you catching a falling knife? I'd love to hear from you. So leave any thoughts you have, any comments you have in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.